Imagine leaving your family with nothing, not because you did not love them, but because you trusted the wrong policy. Right now, over 40 million American households have zero life insurance, and millions more are severely underinsured. Today, we change that. Here's the truth most people never hear. The American life insurance industry generates over $900 billion in annual premiums, and much of that money flows because the average buyer is simply confused. There are over 100 different types of life insurance products: whole life, term life, universal life, variable life, indexed universal life, each sold with the same pitch: this is the best one for you. But here is what your agent might never say. Many of these products generate agent commissions as high as 80 to 100% of your first year's premium. That does not mean agents are dishonest. Most genuinely want to help. But the incentive structure does not always align with your best interests. The result? Millions of families are uninsured, underinsured, or paying far too much for coverage they do not need. Understanding how life insurance actually works is one of the highest value financial decisions you can make. The great debate in personal finance has gone on for decades: term life versus whole life insurance. Term life is straightforward. You pay a monthly premium for a fixed period, typically 10, 20, or 30 years. If you die during that term, your beneficiaries collect the death benefit. If you outlive the policy, it simply expires. A healthy 30-year-old non-smoker can get $500,000 of 20-year term coverage for about $25 to $30 a month. That is roughly the cost of one streaming subscription. Whole life insurance is different. It covers you for your entire life and builds what is called cash value, a built-in savings component that grows tax-deferred. Sounds ideal, right? Here is the catch. Whole life premiums for the same coverage can be 10 to 15 times more expensive than term. That cash value typically grows at a guaranteed rate of 1 to 3%. A basic index fund has historically returned 7 to 10% annually. For most families with young children, a mortgage, and financial goals to fund, term life insurance is the mathematically superior choice. Let us pull back the curtain on something few people ever see: how insurance companies actually calculate your premium. Every major insurer employs specialists called actuaries. Their job is to calculate with extraordinary precision the statistical probability that you will die during your policy period. They analyze dozens of data points: your age, your weight, your blood pressure, your family medical history, whether you smoke, your occupation, and in many states, even your credit score. They plug all of this into something called mortality tables, massive statistical databases built from decades of death records. The result is your rate class. The healthiest applicants receive the designation Preferred Plus. From there, it scales down through Preferred, Standard, and Substandard, where you pay more due to health risk factors. The financial impact is significant. A Preferred Plus applicant might pay 30 to 50% less than someone rated Standard for identical coverage. And here's the most powerful thing you probably did not know: your rate class is not permanent. Losing weight, quitting smoking, managing your blood pressure, these changes can qualify you for a better rate class at renewal or with a new policy. How much life insurance do you actually need? Most agents answer with a formula that sounds simple: 10 times your annual income. But that number was designed to be easy to say, not necessarily the right fit for your family. Here's the framework financial planners actually use. It is called the DIME method. D stands for debt. Total everything you owe, your mortgage, car loans, student loans, and credit cards. I stands for income replacement. Multiply your annual income by the number of years your family would need support, typically 10 to 15 years. M stands for mortgage. Add your outstanding mortgage balance if you have not already included it in your debt calculation. And E stands for education. Estimate the cost of funding your children as education. A 4-year degree today can cost anywhere from $80,000 to $300,000 or more, depending on the school. Add all 4 numbers, then subtract any savings, existing investments, and any life insurance already provided through your employer. The result is your true coverage gap. For a middle-class family with a mortgage and 2 young children, this number frequently lands between $500,000 and $1.5 million. Now, the 5 most expensive mistakes people make when buying life insurance. Avoiding even one of these could save you thousands of dollars. Mistake 1, waiting. Your premium is locked in at your current age and health. Every year you delay, you pay more. A 40-year-old pays nearly double what a 30-year-old pays for the same coverage. Start now. Mistake 2, depending only on employer coverage. Most group policies provide just 1 to 2 times your annual salary. That is almost never enough, and if you leave that job, the coverage disappears. Mistake 3, buying the wrong type. Purchasing whole life when term would serve you better, or the reverse, can cost tens of thousands over a lifetime. Mistake 4, naming the wrong beneficiary. Naming a minor child directly, failing to update after a divorce, or naming your estate instead of a person are all costly errors that can delay or complicate your family's claim. Mistake 5, not comparing quotes. Studies show premiums for identical coverage vary by 40 to 50% across different carriers. Always get at least 3 to 5 quotes before committing. Here's what we covered today. Life insurance is not a product you buy once and forget. It is a strategy, one that requires understanding how the industry actually works, how your premiums are calculated, and how to match the right coverage to your real financial situation. The most important action you can take right now: get started. A basic term life policy purchased today is infinitely better than waiting for a perfect moment that never arrives. If this breakdown was valuable to you, there is much more where this came from. Every week, we go deep on the financial decisions that actually change your family's future: insurance, investing, retirement, and beyond. Subscribe so you do not miss what is coming next. Drop a comment below with your biggest question about life insurance. We read every single one, and your questions shape what we cover next. The goal has never been simply to have insurance. The goal is to have the right insurance at the right time for the right price. That knowledge, it is worth more than any policy.